All right, so I realized I didn't really label this. So this is a chapter 8. Practice problem. And I really like this problem because it has multiple parts, all with the same information, so you can kind of see how everything moves around. This is, I believe, the last problem in the chapter 8 problems, the chapter 8 practice problems that I posted. And so this will come in multiple videos because we have parts A through D with this scenario. So there are going to be multiple videos for this. All right, so let's start with part A. Okay, and so part A asks us the amount of gain or loss that Zhang realizes on the transfer of property to her corporation. All right, so what's happening in general here, we've got this individual who is incorporating a sole proprietorship, and in doing so, she is also transferring inventory, a building, and land in return for 100% of the corporation's stock. The property transferred has all of this following information, okay? And then we've got some additional information. The corporation has also assumed a mortgage attached to the land and building. We've got the fair market value of the corporation's stock received in exchange, right? And it says the transaction met the requirements to be tax deferred under Section 351, okay? So what do we know? Well, we know that this qualifies as tax deferred. So she gets 100% of the stock, and we knew that she would have to have at least 80%, right? Because she's contributing all of this property. All right, so that's the kind of the nuts and bolts of the situation. So now let's look at what we're asked for in part A. Okay? All right, so part A asks us what gain or loss is realized by Zhang. Okay, so what do we know? All right, so realized. What does she receive, right? Well, she gets some stock, and we have to look at the fair market value of the stock received. And we were told that the fair market value of the corporation's stock received in the exchange was $300,000. So that was part of the given information right there. Okay. What do we also know? We also know that the corporation assumed a mortgage attached to the building and land. Okay. So she also received the mortgage assumed by the corporation. All right, so amount realized is $400. So what did she realize? She realized $400, but that is not what the question asked for. The question was more specific. The question asked for what amount of gain or loss did she realize? Okay, so now what do we have to do? Well, we have to look at the adjusted basis of the property that she transferred. Okay, and what was the adjusted basis of our property that was transferred? Well, if we go up here and look, what did she transfer? She transferred inventory, she transferred building, she transferred land, and our total adjusted basis is this $410,000. Okay? So we have to subtract out that $410,000. So what do we have? We have a situation where she realized a $10,000 loss. Okay, so that was part A. Now part B, if we explode this back up, part B, what amount of gain or loss does Zhang recognize on the transfer of property to her corporation? So remember, realized and recognized are not always the same, right? Realized is more normal, but there are specific situations where the tax code says you do not have to or you do not get to recognize the gain or loss. Section 351, tax deferred transfers are one of those situations. So for B, lost recognized is 0. Since the transfer qualifies as Section 351. Okay, so this video isn't getting too long yet, so let's try to get at least part C in here on the same video. And we should be able to get C and D, I think. And then we'll do the next part. So right now, let's look at C, okay? So C is asking about Zhang's tax basis in the stock she receives, okay? So I'm going to switch colors for that, all right? And so part C is, what is the tax basis in the stock she receives? So we'll scroll down. Okay, so what do we know? Well, we know when you exchange property for stock, we have this concept called substituted basis. Okay, so the stock you receive is going to have the same tax basis as the assets that were transferred. But you do have to adjust for any mortgage assumed by the corporation. Okay, so what does that mean? Well, okay, so we have to find the tax basis of the assets that she transferred, all right? And from a previous part, we remember that the tax basis of the assets transferred is $410,000. Okay. And from a previous part, we know that there was a mortgage assumed. So what does that do? Well, that gives us a tax basis So her tax basis in the stock is $310,000. All right. All right. So finally for this video, let's look at part D, and then I'll post part 2 with the other parts. But let's look at part D. All right. So we got to scroll all the way back up. All right. So let's look at part D. So part D asks, what is the corporation's adjusted basis in each of the assets received in the exchange? Okay, so now we're looking at it from the corporation's point of view, and we have to figure out the adjusted basis in each of the assets. All right, so let's get set up, and then we'll come back up for more information. So D asks us, what is the adjusted basis in each asset? I'm going to make one change here. Add what is the corporation's adjusted basis in each asset. All right, that way it's clear. Okay, so let's look at, we'll just write down the assets that we have. Okay, now, what do we know? Well, what we know is normally the corporation gets carryover basis. So normally, the corporation's tax basis equals the transferor's tax basis. Okay? Now, there is an exception. Okay, and the exception is when the tax basis of the assets exceeds the fair market value of the assets. Okay, so let's scroll up and look at what's going on. Okay. All right. So what do we see? Okay, so if we're looking at inventory, the adjusted basis is $10,000. Fair market value is $20,000. So fair market value is greater than the adjusted basis. So we're fine. There's not what is called a built-in loss. Okay. with our building. We've got an adjusted basis of $100,000 and a fair market value of $150,000. Again, no built-in loss. Now, what do we see with the land? With the land, we have an adjusted basis of $300,000, but fair market value has fallen below the adjusted basis. So here we have what is called a built-in loss. And we can see that our adjusted basis is larger, our total adjusted basis, I should say, is larger than our total fair market value. Okay? Now, if this were a situation where each one of these assets had a built-in loss, then we would allocate that built-in loss ratably across the assets. But that is not the situation that we have. What we have here is the built-in loss can be clearly attributed to only the land. Okay, so let's scroll down here and we'll write down what we just figured out. Okay, so for the inventory, what do we get? Well, for the inventory, we get carryover basis. Okay, fair market value was greater than its adjusted basis, so we get carryover basis of $10,000. Okay, the building also, we get carryover basis because its fair market value was still larger than its adjusted basis. So our basis in the building is $100,000. Now, what do we know about the land? Well, what would we normally get? Normally we would get carryover basis, right? So our starting point is going to be that carryover basis. But in this situation, what was our built-in loss? Well, our built-in loss equals $10,000 because our adjusted basis is $10,000 larger than our fair market value. All right? So in this situation, that's clearly attributed to the land. So this is land, this is our carryover minus our built-in loss, which is $10,000. So that gives our new basis in the land from the corporation's perspective of $290,000. So what is our total basis for all of these assets? Well, we just add up the $10,000, the $100,000, and the $290,000. And we get $400,000 of total tax basis for the corporation. All right, so that's parts A through D, and there will be a second video as well. Thanks, guys. And then we have some slight adjustments, and then we have parts E through G.